For years, Florida looked unstoppable. Sunshine, no state income tax, booming real estate, people poured in from New York, California, the Midwest. Investors snapped up properties, rent soared, home prices exploded. Florida became the symbol of American migration. But something has shifted. In 2026, millions aren't arriving anymore. They're leaving, quietly, gradually, city by city, neighborhood by neighborhood. And it's not because Florida suddenly became undesirable. It's because the math stopped working. Insurance premiums doubled, then tripled. Property taxes reset higher. HOA fees climbed. Wages didn't keep up, and the costs that used to be invisible are now unavoidable. Here's the part most headlines miss. This isn't a political exodus, it's a financial one. People didn't leave Florida because they wanted to. They left because staying no longer made sense. A place built on affordability and lifestyle became fragile when fixed costs exploded. When insurance becomes unpredictable, housing markets don't just cool, they destabilize. As we break this down, pay attention to the pattern. Rising housing costs, climate risk priced into insurance, infrastructure strain, and job markets that don't always justify the cost of living anymore. But here's the second half of the story. People aren't just leaving Florida, they're going somewhere specific, and those destinations tell you everything about what Americans are prioritizing next. Stability, predictability, and costs that won't jump overnight. Watch through the full list, because the final destinations may surprise you. Some are booming quietly, others are absorbing Florida's outflow faster than local markets can handle. And before we continue, hit like, subscribe, and share this video. It helps the channel grow and makes sure you don't miss the next deep dive into the biggest migration and housing shifts shaping 2026. Let's start with why Florida's largest metros are feeling the pressure first. 1. South Florida, Miami-Dade, Broward, Palm Beach. South Florida didn't suddenly break. It priced people out slowly, then all at once. For years, Miami and the surrounding counties were the final destination. Sunshine, no state income tax, global culture, and a housing market that seemed immune to downturns. Remote workers arrived in waves. International money flooded in. Luxury towers reshaped the skyline. Prices surged, but demand kept up, until the cost structure underneath cracked. Insurance was the turning point. Homeowners watched premiums double, then triple. Some insurers pulled out entirely. Others returned with massive deductibles, reduced coverage, or prices that shattered affordability. For many households, insurance rose faster than the mortgage itself. That changed everything. Housing stopped being a lifestyle choice and became a monthly gamble. Then came the condo shock. New safety laws forced associations to fully fund reserves. Buildings that deferred maintenance for decades were suddenly required to collect massive sums. Special assessments landed in the tens of thousands. Retirees on fixed incomes were trapped. Younger owners saw the numbers and sold. Investors exited quietly before costs climbed further. Wages never caught up. South Florida's economy leans heavily on hospitality, healthcare, and service work. Those sectors don't support luxury-level housing costs. Remote workers could absorb volatility. Locals couldn't. That split the market into two tiers and hollowed out long-term stability. People didn't flee overnight. First, they downsized. Then they rented. Then they delayed repairs and discretionary spending. Finally, they listed. The exodus was gradual, but it was persistent. Neighborhoods didn't empty, but turnover accelerated. Schools felt it. Small businesses felt it. Communities thinned. Another layer made it worse. Unpredictability. Buyers could no longer estimate future costs. Insurance quotes changed year to year. HOA fees jumped without warning. Property taxes reset higher after sales. The Florida promise of low-friction living disappeared. South Florida didn't lose demand. It lost balance. Luxury demand remains. Cash buyers remain. But the middle class that stabilized neighborhoods is shrinking. Housing markets don't collapse when rich buyers leave. They collapse when everyday households do. In 2026, South Florida is still desirable, but it's no longer sustainable for millions who once made it work. And once people realize the math won't improve, they don't wait for conditions to worsen. They leave while they still can. 2. Tampa Bay, Florida. Tampa Bay was supposed to be the backup plan. When South Florida prices surged, Tampa became the alternative. Same state benefits, coastal lifestyle, growing job market. For a few years, the narrative held. Families moved in. Investors followed. Suburbs expanded rapidly. Home prices climbed, but they still looked reasonable compared to Miami or Fort Lauderdale. Then, the cost structure caught up. Insurance was the first pressure point. Homeowners began receiving renewal notices that didn't make sense. Premiums jumped dramatically. Even for properties far from the immediate coastline, flood zones expanded, wind coverage tightened. Buyers found themselves unable to close because insurance costs pushed monthly payments beyond what lenders would approve. That was the first signal that Tampa's affordability was fragile. The second issue was wages. Tampa's economy is diverse, but it's not high-paying enough across the board to support coastal-level housing costs. Healthcare, logistics, retail, and service jobs dominate much of the employment base. When housing costs rose at a pace normally seen in luxury markets, income didn't follow. Renters felt it fastest. Rents climbed sharply, then stalled as residents hit affordability ceilings. Some doubled up, others moved farther inland. Many left the region entirely. Investors amplified the volatility. During the low-rate era, Tampa became a favorite for single-family rentals and short-term investments. As costs rose and cash flow tightened, those same investors became quick sellers. That added inventory in pockets of the market that once looked untouchable. Infrastructure strain made things worse. Roads, drainage, utilities, and schools struggled to keep up with sudden population growth. Commutes grew longer. Utility bills rose. Quality of life costs added up in ways newcomers didn't anticipate. Tampa didn't become expensive overnight. It became unpredictable. Housing markets can tolerate high prices if costs are stable. They struggle when expenses change without warning. Insurance renewals, tax reassessments, and HOA increases introduced uncertainty that families don't tolerate for long. Another subtle factor pushed people out. Expectations. Many who moved to Tampa did so believing it was a long-term solution, not a temporary stop. When the math stopped working, they didn't wait to see if conditions improved. They moved again, this time out of Florida. Tampa Bay isn't emptying, but the growth engine that fueled its housing boom has slowed sharply. In 2026, the city feels less like an affordable alternative and more like a cautionary example. It's a reminder that when a market grows too fast without the income base to support it, the adjustment doesn't announce itself. It happens quietly, household by household, until the migration numbers tell the story after the fact. 3. Orlando, Florida. Orlando's problem isn't tourism. It's dependence. For decades, Orlando's economy has revolved around one engine: visitors. Theme parks, hotels, entertainment, and service jobs built a massive employment base that worked when housing was cheap and costs were predictable. But in the last few years, that balance collapsed. Housing prices surged faster here than wages ever could. Rent doubled in many areas. Home prices followed. But Orlando's dominant job sectors didn't change. Hospitality, retail, and service work still make up a large share of employment, and those wages simply don't support today's housing costs. When living expenses rise faster than income, households don't adapt forever. They exit. Insurance accelerated the pressure. Many Orlando residents assumed living inland insulated them from Florida's insurance crisis. It didn't. Premiums still rose sharply. Wind coverage tightened. Deductibles climbed. Even renters felt it as landlords passed costs through. The idea that Orlando was safe Florida quietly disappeared. Then there's the short-term rental effect. Entire neighborhoods shifted toward vacation rentals. Investors chased returns. Inventory for long-term residents shrank. Prices rose again. Locals were pushed farther from job centers, increasing commute times and transportation costs. What looked like growth from the outside felt like instability from the inside. Families noticed first. School enrollment patterns began shifting. Parents moved children mid-year. Healthcare workers and teachers left for cheaper states. These are early warning signs most people miss. When essential workers leave, housing markets lose their foundation. Infrastructure strain added another layer. Roads clogged. Utilities expanded slowly. Local governments struggled to keep up with population spikes. Quality of life costs increased in ways spreadsheets don't capture. The biggest issue, though, was uncertainty. Residents couldn't predict next year's rent. Homeowners couldn't predict insurance renewals. Investors couldn't predict regulation around short-term rentals. Housing markets can survive high costs, but they don't survive instability well, so people made rational choices. Some moved north within Florida, others skipped that step and left entirely. States with steadier job markets, lower insurance volatility, and slower but more reliable growth became attractive. Orlando didn't experience a dramatic collapse. It experienced erosion. Household by household, the city lost residents who once made the system work. Tourism remained strong. Visitors still come, but visitors don't anchor housing markets. Residents do. In 2026, Orlando is still growing on paper, but the composition has changed. Shorter stays, higher turnover, fewer long-term routes. That's the quiet shift reshaping the city. And once a housing market loses its long-term residents, it doesn't correct smoothly. It becomes fragile, waiting for the next shock to expose what's already been weakening underneath. 4. Jacksonville, Florida. Jacksonville was supposed to be Florida's pressure valve. When South Florida overheated and Tampa got expensive, Jacksonville looked like the smart move: cheaper housing, fewer hurricanes, a growing logistics, healthcare, and military presence. On paper, it checked every box for families trying to stay in Florida without paying coastal prices. For a while, it worked. Then growth arrived faster than Jacksonville was prepared for. Investors flooded in, snapping up single-family homes at a pace the local market had never seen. Rents jumped sharply. Home prices followed. What used to feel affordable started to feel tight, especially for long-time residents whose wages hadn't changed. Insurance became the next problem. Many buyers assumed Jacksonville's northern location insulated it from Florida's insurance crisis. It didn't. Premiums rose anyway. Wind coverage tightened. Deductibles increased. Even homes far from flood zones saw major jumps. For first-time buyers, insurance alone was enough to break affordability. Jacksonville's job market made this worse. While the city has growth sectors, many jobs still sit in moderate-paying ranges. Logistics, transportation, healthcare support, and retail don't absorb rapid housing inflation well. As costs climbed, residents didn't have the income buffer seen in wealthier metros. Then came infrastructure strain. Jacksonville is large geographically, and expansion pushed outward quickly. Roads clogged, commutes grew longer, utility systems struggled to keep pace. Water, sewer, and drainage projects lagged behind development. Quality of life costs rose in ways people didn't anticipate when they moved. Here's the key issue. Jacksonville didn't just get more expensive, it became unpredictable. Residents couldn't forecast their costs. Rent renewals jumped unexpectedly. Insurance renewals shocked homeowners. Property taxes reset higher after sales. Families can manage high costs if they're stable. They can't manage surprises. That's when relocation decisions accelerate. Many residents didn't move because they wanted to leave Jacksonville. They moved because staying meant accepting constant financial uncertainty. Once people realize the math won't stabilize, they stop waiting for improvement. Another subtle signal appeared in school enrollment and workforce turnover. Teachers, healthcare workers, and public sector employees began leaving for states with lower housing pressure and steadier costs. These groups form the backbone of housing stability. When they exit, markets weaken quietly. Jacksonville still attracts newcomers, but it's also losing long-term residents at a pace that offsets gains. High turnover changes neighborhoods. It reduces community attachment. It increases rental concentration. All of those make housing markets more volatile. In 2026, Jacksonville isn't collapsing, but it's no longer the safe harbor it once appeared to be. It's caught between growth and affordability, with insurance and infrastructure tipping the balance. And when a market loses its affordability advantage without gaining high incomes to replace it, the next move for many residents is simple. They leave the state altogether. 5. Central Florida and inland suburbs. When South Florida and Tampa became unaffordable, many families looked inland to Central Florida and surrounding suburbs. Cities like Kissimmee, Claremont, Winter Haven, and parts of Polk and Lake counties seemed like the perfect compromise. Lower housing costs, proximity to jobs, and still within Florida's Sunshine Belt. But what appeared safe on paper is proving less stable in 2026. The first hidden pressure is insurance. Inland doesn't mean immune. Flood zones have expanded, wind coverage tightened, and homeowners' premiums have climbed dramatically over the past several years. Policies now cost multiples of what they did a decade ago, even for properties miles from the coastline. For middle-income families, that alone can make monthly budgets untenable. Property taxes and utility costs are the second layer. As population flows inward, local municipalities increase taxes and fees to support infrastructure expansion. Schools, roads, water, and sewer systems. What seemed like a trade-off, a cheaper home with the same quality of life, is eroded as hidden costs rise. For many families, the total monthly expenses rival coastal regions they were trying to escape. Rapid population growth adds another complication: infrastructure strain. Roads become congested, water treatment and sewer systems operate near capacity, and public services struggle to keep pace with the influx. Developers can't always meet demand on schedule, and permits may slow as city governments adjust to the surge. That unpredictability creates friction in housing markets. Short-term rentals and investor activity amplify the problem. Many inland suburbs became attractive to investors seeking to capture out-of-state demand at lower entry prices. While this increases property values, it also reduces availability for local buyers. Residents feel the squeeze: fewer homes, higher prices, and rising rents. Markets that once seemed affordable start to resemble South Florida's volatility, just on a delayed timeline. Employment dynamics also matter. Inland suburbs often lack the high-wage professional sectors found in Tampa, Orlando, or Miami. Jobs exist, but many new residents commute long distances or work in lower-paying service or logistics roles. Combined with rising housing costs, this creates a pressure point that makes leaving the state more appealing than staying. Migration patterns show subtle but steady outflows. Residents moving inland often leave again when costs, insurance, or commuting pressures reach tipping points. Florida's inland growth is less about boom and more about delayed adjustment. The same forces pushing families out of coastal metros eventually reach these communities too. Residents feel the squeeze: fewer homes, higher prices, and rising rents. Markets that once seemed affordable start to resemble South Florida's volatility, just on a delayed timeline. Employment dynamics also matter. Inland suburbs often lack the high-wage professional sectors found in Tampa, Orlando, or Miami. Jobs exist, but many new residents commute long distances or work in lower-paying service or logistics roles. Combined with rising housing costs, this creates a pressure point that makes leaving the state more appealing than staying. Migration patterns show subtle but steady outflows. Residents moving inland often leave again when costs, insurance, or commuting pressures reach tipping points. Florida's inland growth is less about boom and more about delayed adjustment. The same forces pushing families out of coastal metros eventually reach these communities too. 6. Why Florida is losing people. Florida's population shift in 2026 isn't driven by politics, lifestyle, or hurricanes alone. It's driven by math. Fixed costs have grown faster than incomes, creating pressure that residents can't ignore. For decades, Florida offered the promise of sunshine, low taxes, and lifestyle freedom. That promise worked because living costs were manageable, wages reasonably aligned, and risks abstract. But in 2026, the hidden costs are visible, unavoidable, and accelerating the outflow. Insurance tops the list. Homeowners face skyrocketing premiums for wind, flood, and general coverage. For many, annual increases double or triple the original policy cost. Some insurers refuse to renew, forcing residents to shop in a market with few options, high deductibles, and strict exclusions. Even inland properties see increases as flood zones expand and windstorm coverage adjusts for climate volatility. Insurance alone can make staying financially untenable. Property taxes are another key driver. Rising assessments, particularly in growing counties, compound the cost of owning a home. These increases often lag behind market prices, but when combined with insurance and utilities, monthly budgets feel stretched. Many families find they are paying the equivalent of coastal prices without the same level of protection or amenities. HOA and community fees add a third layer. New legislation, reserve requirements, and maintenance obligations have made community living more expensive. What once seemed like manageable monthly fees are now significant line items. For middle-income households, this can tip affordability into stress, especially for those on fixed or slowly growing incomes. Utilities, transportation, and infrastructure costs further squeeze families. Rapid population growth in suburban and inland areas drives up municipal charges, water, and sewer fees. Longer commutes from suburban sprawl increase fuel expenses. Together with insurance and taxes, these hidden costs quietly erode the financial stability of households. The result is predictable. When residents can't forecast their expenses or control rising costs, they leave. Florida isn't losing people because it's undesirable. It's losing people because staying is financially uncertain. Families move before conditions worsen, seeking stability over proximity, sunshine, or lifestyle branding. Middle-class households are the most affected. Wealthier residents can absorb volatility, and tourists and seasonal residents remain untouched. But the backbone of Florida's stable communities, teachers, service workers, healthcare employees, and long-term families, are leaving first. That gradual exodus undermines neighborhoods, school systems, and local economies, creating a cycle that amplifies outflow. 7. Texas destinations. Texas is absorbing Florida's exodus, but it's not random. Former Floridians aren't just moving to the first affordable state they see. They're targeting specific metros where housing, jobs, and stability align. In 2026, Texas has emerged as the leading destination for people fleeing rising costs, insurance spikes, and financial uncertainty back home. Dallas-Fort Worth is at the top of the list. The metro offers a diverse economy, from tech to finance to logistics, and a housing market that, while heated, is still more predictable than Florida's coastal metros. Suburbs like Frisco, Plano, and McKinney are particularly attractive. These areas have modern infrastructure, quality schools, and communities designed for growth. Builders have kept up with demand, which prevents the sudden supply shortages that Florida residents faced. Even insurance is more stable here, with fewer extreme swings compared to South Florida. San Antonio has also seen a significant influx. People are drawn to its relatively low cost of living and stable property markets. The city benefits from a large military and government presence, which supports steady wages. Neighborhoods expand gradually, and development tends to be regulated to prevent sudden strain on infrastructure. For families seeking predictability after Florida's volatility, San Antonio offers a combination of affordability, safety, and community stability. Houston absorbs migration differently. Coastal and flood-prone areas are avoided, but inland suburbs like Sugar Land, the Woodlands, and Katy are booming. Texas residents and incoming Floridians prioritize areas with lower flood risk and strong municipal services. Even as Houston's energy sector fluctuates, these suburbs provide predictable housing options, good schools, and steady infrastructure, which are exactly the qualities that Florida transplants are looking for. Why Texas? It comes down to three factors: no state income tax, a diversified economy, and housing markets that have maintained supply relative to demand. People leaving Florida aren't chasing climate alone, they're chasing predictability. They want places where their mortgage, insurance, and utility costs can be anticipated. Texas metros fit that criteria better than most states, and they can absorb large inflows without creating the same volatility seen in Florida. Migration patterns show that families, retirees, and investors are choosing Texas suburbs strategically. School districts are a major draw, and proximity to major employment centers matters. People are bypassing central cities if the infrastructure is old or flood-prone, favoring communities with modern planning and growth management. 8. North Carolina. Charlotte and Raleigh are magnets for former Floridians in 2026. Families and professionals are leaving Florida and heading to the Carolinas in search of affordability, predictability, and jobs that match their living costs. Charlotte stands out for its finance and tech sectors, high-paying jobs, steady economic growth, and suburban communities with strong schools make it ideal for families looking to replace Florida's volatility with stability. Housing markets are hot but more balanced than South Florida. Inventory exists, and new developments are carefully managed to avoid sudden spikes in costs. Raleigh appeals to tech professionals and families alike. The Research Triangle's strong employment base, moderate cost of living, and inland location reduce insurance risks, which have become a major concern for Florida residents. Newcomers are drawn to areas where monthly budgets can be predicted without fear of massive spikes in premiums or taxes. In both metros, migration isn't just about cost, it's about confidence. People want cities that will handle growth without overloading infrastructure. Roads, schools, water, and utilities are scaling with population, which provides peace of mind that housing won't suddenly become unmanageable. These moves are already reshaping local markets. Suburbs are expanding quietly, inventory is tightening, and developers are accelerating projects to meet new demand. But unlike Florida's chaotic boom, growth is measured, which makes it easier for residents to integrate and plan long-term. For families leaving Florida, North Carolina offers predictability. Jobs, housing, and infrastructure are aligned, giving people control over their financial futures. That's the primary driver in 2026. Stability, not sunshine. 9. Tennessee. Tennessee has quietly become a major destination for former Floridians in 2026. Cities like Nashville, Knoxville, and Chattanooga are absorbing families, retirees, and professionals seeking affordability, safety, and stability after Florida's rising costs and insurance volatility. Nashville draws newcomers with its booming healthcare, tech, and logistics sectors. Wages are higher than Florida's service-heavy markets, and the housing supply, while growing, remains more predictable. Suburbs around Nashville, like Franklin and Murfreesboro, offer modern communities, good schools, and less risk of natural disasters. That predictability is exactly what people fleeing Florida are looking for. Knoxville and Chattanooga attract families seeking inland safety. Insurance premiums are lower, property taxes manageable, and utility costs stable. Residents are trading the Florida coastline for reliability, knowing that predictable expenses allow them to plan and grow without surprises. Tennessee's appeal isn't just financial. Quality of life, community infrastructure, and long-term growth potential make it a strategic choice. Unlike Florida, these cities can absorb newcomers without creating housing volatility. Commuting, schools, and public services are scaling with population, ensuring families don't encounter the same hidden costs that force them out of Florida. The trend is clear. Tennessee offers stability, predictability, and economic opportunity. Families aren't just moving, they're recalibrating their lives to align with manageable costs. In 2026, Tennessee stands out as a reliable alternative for those leaving Florida's uncertain housing and insurance markets. 10. Midwest comeback cities. The Midwest is quietly benefiting from Florida's 2026 exodus. States like Ohio, Indiana, and Michigan are seeing families and retirees relocate in search of stability, affordability, and predictable living costs. Cities such as Columbus, Indianapolis, and Detroit suburbs are attractive because housing is still affordable, property taxes are steady, and insurance premiums are far lower than Florida's coastal markets. Families moving from Florida find they can buy larger homes, enjoy more space, and maintain a monthly budget that isn't constantly threatened by rising insurance or HOA costs. Employment opportunities matter too. While the Midwest doesn't offer Florida's weather or sunshine, it provides strong healthcare, manufacturing, logistics, and professional services sectors. Wages may be moderate, but they align well with housing and living expenses. People leaving Florida prioritize that predictability over lifestyle perks they can no longer afford. Infrastructure and community stability play a key role. Suburbs and smaller cities are absorbing newcomers without creating sudden spikes in costs. Schools, roads, and utilities scale gradually, providing the reliability families need. Unlike Florida's chaotic housing markets, Midwest markets grow steadily, giving newcomers confidence that their investment and lifestyle are secure. The migration is more than numbers, it's strategic. People are choosing the Midwest because it balances affordability, predictability, and long-term quality of life. In 2026, these cities aren't just destinations. They're safe harbors for households escaping Florida's rising costs, insurance volatility, and infrastructure strain. Florida isn't emptying out, it's recalibrating. Millions aren't fleeing the sunshine, they're fleeing unpredictability. Rising insurance costs, skyrocketing property taxes, HOA fees, and volatile housing markets have created a financial pressure cooker that even longtime residents can't ignore. The cities we covered, from South Florida and Tampa Bay to Orlando and Jacksonville, show the pattern clearly. Costs are rising faster than wages, infrastructure struggles to keep pace. Families are making rational choices, stability over location, predictability over lifestyle, and the inland and out-of-state destinations, Texas, North Carolina, Tennessee, and the Midwest, are absorbing this migration because they offer what Florida increasingly cannot: affordable housing, manageable costs, and peace of mind. For viewers watching this, the lesson is simple. Housing markets and migration trends are more than statistics. They're signals. If you're buying, selling, or investing in Florida or migration hotspots, pay attention to insurance rates, property taxes, and infrastructure strain. The first ones to act are often the ones who benefit the most. So, here's what to do next. Hit that like button, subscribe for more deep dives into real estate and migration trends, and share this video so others can see the hidden risks before it's too late. Comment below, which Florida city do you think will see the biggest outflow in 2026? And where would you move if you had to leave? Don't wait for headlines to tell the story. Be ahead of the trend. Hit the notification bell and stay informed, because understanding these shifts now can save money, stress, and future regret.